So hi dear traders, in this video I am going to explain you what is option chain for any index. If you see in this chart, this is called Nifty chart. We are seeing Nifty is a type of one index in our Indian trading. That Nifty will have nearly 50 companies. Okay, the total 50 companies performance will be traded as a Nifty 50, which is very popular, and it has only weekly expiry. So previously Bank Nifty is having weekly expiry, where there is a very big volatilities are there. At that time Nifty is not moving much, so most of the people went for Bank Nifty. But after SEBI rules, they have been changed to Nifty as a weekly expiry, so that now the momentum is very good for Nifty. So most of the people who traded for Bank Nifty, they have been shifted to Nifty because Bank Nifty is monthly expiry, where the momentum is not much. But Nifty nowadays, I think it is moving around 200, 300, sometimes 700 points also I have seen. So generally most of the people turn to Nifty trading. So if the volume is good, where it will be good, there if you trade, you will get a better results. If volume is very less in that index, if you trade, I think it will be in most of the time sideways, so you may not get profit. So this is about Nifty chart. In this Nifty chart, if you see here, there is two display here, call and put. Here you are seeing call and put. In the call side, in the middle, call and put, in the middle there is one name called as strike. What do you mean by strike price means? If you see here, we have one value 23,897. This 23,897 is a closing value, okay, on previous day. So this is the closing value. Maybe it is showing 23,903, but it has been closed at 23,897. That has been closed there. We call this as spot price. This is called spot price. At what price it is now located, we call it as spot price. Now the strike price meaning is, above this we have a multiple of 50 times the strike price will be decided. Above this we are seeing 23,850. After that 800, 750, 700. Like that we'll have some strike prices. The difference between each strike price will be having 50 points. Now below also you can see 900, 950, 24,000 like that. What is the meaning of this strike price is, if you see this line, this boundary line where you have the spot price, on call side if you go above this, if any premium you are taking, LTP is called as latest traded price. In the call side if you take above this any premium, we call it as in the money. In the money. What is the advantage of taking in the money, and if you trade it, what is the advantage is, the time decay of the premium will be less, and you are going to get a good benefit of profit also, because whenever the market is moving, fast in your direction, you are going to get this premium also will move very fast. So better taking this portion which is called in the money in call side is better for the intraday trading for you. And if you come downside, if you trade this, we call it as out of the money. In out of the money, what happens is the premium value will be divided into two parts. One is intrinsic value and one more is time decay. If it is reducing like that with respect to time, only intrinsic value will be remaining in the premium. So I think whenever you want to go for buying, don't go for below these values, go for above these values, which will give advantage for you. Below this if you go, the premium decay will be very fast, so that you may not get, if the direction of the momentum is in your side also, you may not get that much profit. So out of the money is not preferred for the buyers, but out of the money is being preferred for the sellers. Sellers के लिए we have the out of the money, where the time decay if it comes, for seller it is advantage, for buyer it is not advantage. So for buyers these premiums are good, for sellers these premiums are good. If you come to the same put side, if we go above this spot price, In put side, this is called out of the money. We call this as out of the money. Below this we call it as in the money. So for the put side, bottom side is in the money, above is out of the money. Whenever I say the word out of the money, it is better to take the premium for sellers, and in the money is better for buyers. This much information if you know, you can start trading. Whether you can decide you are a buyer or a seller. The only thing I want to tell you is for buyers, you have to go for in the money premium. Okay, out of the money premium will be taken by sellers. So these things you must know before starting the trading. This is one of the simple explanation I am giving for strike price, how to decide. And if you go the strike price in call side above and above like this, your value of movement will also, the speed of the movement of your premium also will increase. If you take here, suppose if it is 0.6 speed, if you go here 0.7 speed will be there, 0.8. So whenever you are going in depth of the in the money, the speed of the premium also will increase according to the index movement. So that point you have to understand. Okay, most of the people will do here the premium where the spot price is there, close values they will take for trading, such that if you do at 220.90, we call it as at the money. Just you are on the money where the spot price is there, there you are starting trading. So whenever you trade here 220.90, the premium value will be less, the funding will be less for the buyer. At the same time, the movement also will be good for you. Okay, thank you very much.